Most Americans believe that once their credit score hits 700, they've made it. They think they're financially responsible. They think banks will treat them fairly. But here's the uncomfortable truth. In today's financial system, a 700 credit score is not good anymore. It doesn't qualify you for the best interest rates. It doesn't put you in the safest category. And most importantly, it quietly costs you money. Not because you're irresponsible, but because of how the system is designed. And banks don't explain this, because they don't need to. First, let's clarify something crucial that many Americans overlook. There are two main credit scoring models in the U.S., FICO and VantageScore. FICO is the one that matters most, as it's used by about 90% of top lenders for decisions on mortgages, auto loans, and credit cards. VantageScore, created by the three major credit bureaus, Equifax, Experian, and TransUnion, is more inclusive. It factors in trended data like how your balances change over time and can score people with thinner credit histories. But scores can differ between the two by 20 to 40 points, so always check your FICO score specifically when applying for big loans, as that's what lenders like Fannie Mae and Freddie Mac rely on for mortgages. As of late 2025, with rates stabilizing around 6.2 to 6.3% for 30-year mortgages, these models are precise, but the core issue remains. A 700 on either isn't elite anymore. For years, Americans were told that credit scores work on a simple scale. Below 600 is bad, 650 is okay, 700 is good, anything above that is excellent. And back then, that belief wasn't entirely wrong. But the credit system evolved, especially after the 2008 financial crisis. Lenders got access to better data analytics, machine learning, and automated risk assessment tools. This allowed them to slice borrowers into finer categories based on massive data sets from millions of consumers. High interest rates in recent years have also made lenders more cautious, pushing the bar higher for premium status. Lending became automated, risk models became more precise, and banks stopped thinking in terms of good and bad. They started thinking in tiers, risk tiers, pricing tiers, profit tiers. And that's where the misunderstanding begins. Because while consumers still think 700 is a finish line, lenders see it as a middle category, below the national average FICO score of around 715 as of late 2025. When a bank looks at your credit score, it doesn't judge your character. It runs you through a pricing model. Most major lenders, including mortgage lenders, auto lenders, and credit card issuers, use variations of the same internal ranges. They typically break borrowers into categories that look like this: below 670, high risk; deep subprime to subprime, where delinquencies are rising fast in 2025, especially for auto and personal loans; 670 to 719, moderate risk; near prime, where you're approved but penalized; 720 to 759, low risk; 760 and above, very low risk or preferred borrower; super prime, where the real perks kick in. The key detail most people miss. A 700 credit score sits inside the moderate risk category. That means you're not considered unsafe, but you're also not considered premium. You're reliable enough to lend to, but not valuable enough to reward. And that distinction changes everything. To understand why, let's break down what goes into your score. Knowledge every American should have. FICO scores are calculated based on 5 factors. Payment history, 35%. This is the biggest. Late payments can tank your score for up to 7 years. Amounts owed, credit utilization, 30%. How much of your available credit you're using. Aim for under 30%, but elite scorers keep it below 10%. Length of credit history, 15%. Longer is better. Don't close old accounts. New credit, 10%. Too many inquiries signal risk. Credit mix, 10%. A healthy variety of credit types, like cards, loans, and mortgages, shows responsibility. If your score is stuck at 700, it's often due to high utilization, a short history, or minor dings like a forgotten late payment. But here's the good news. Moving to 760 is achievable with targeted steps, which I'll cover later. Let's talk numbers, because this is where the damage actually happens. And I'll use real late 2025 data to show the impact. Imagine two borrowers. Same income, same job, same city, same house price. One has a 700 credit score, the other has a 760 credit score. On a $300,000 mortgage, that difference can easily result in an interest rate gap of 0.2% to 0.5% or more. As of late December 2025, average 30-year mortgage rates are around 6.2 to 6.3% overall, but for a 700 score, you're likely looking at the higher end, while someone at 760 might get closer to the best offers. Even a 0.5% doesn't sound dramatic, but over a 30-year loan, that gap can translate into tens of thousands in extra interest, enough for a nice vacation fund or emergency savings. Not because the 700 borrower is risky, but because the system charges them for not being elite. The same pattern shows up with auto loans. Average new car rates are around 6.6% overall in late 2025, but for 700 scores, you're looking at 7 to 9% versus 5 to 6% for 760 plus. On a $40,000 loan over 72 months, that's thousands extra. Used cars? Rates average over 11%, with even bigger gaps. Credit cards. Average APR is around 23 to 24% in 2025, but prime cards for 760 plus offer lower ongoing rates and better rewards, while 700 scorers get stuck higher. That means carrying a balance costs you hundreds more annually. Insurance premiums. Many states allow credit-based insurance scores. A 700 might hike your auto or home policy by 20 to 50% compared to 760. Even rentals and jobs. Landlords and some employers check scores. 700 might mean higher deposits or missed opportunities. A 700 score doesn't block you, it taxes you slowly, and slow costs are the hardest to notice. From a bank's perspective, borrowers with credit scores around 700 are ideal. Here's why. You're disciplined enough to make payments. You're unlikely to default. Delinquency rates for this tier are low in 2025 data. But you're still priced above the lowest risk tier. That means higher interest, higher margins, lower risk. In simple terms, you're profitable. Banks don't need to pressure you. They don't need to deny you. They just quietly charge you more. And you keep accepting it because you think you're already good. That's not manipulation. That's math. So why don't people push past 700? Because psychologically, 700 feels like success. Credit apps celebrate it, articles praise it, friends congratulate it, and once you reach it, the urgency disappears. The problem is, the system never tells you that the real benefits don't start at 700. They start later, at 740 for many mortgages, at 760 for super prime perks, at the point where lenders stop pricing you defensively and start pricing you competitively, offering better rewards, waived fees, and faster approvals. But because the cost of staying at 700 is spread out over years, people never feel the pain immediately, and what you don't feel, you don't fix. Now, if you're at 700 and want to climb to 760 or higher, where the average American sits around 715, here's an in-depth, actionable plan based on proven strategies. This isn't quick fix hype, it's what credit experts recommend in 2025. Check your reports annually for free at annualcreditreport.com and dispute errors. Up to 25% of reports have mistakes that drag scores down. Crush utilization. Pay down cards to under 10% of limits. If your limit is $10,000, keep balances below $1,000. Report mid-cycle payments if needed. Automate payments. Never miss a due date. Set up autopay for everything, as on-time history is 35% of your score. Avoid new credit. No new cards or loans for 6 to 12 months. Inquiries drop your score temporarily. Build history wisely. Keep old accounts open, even if unused. If you lack mix, consider a small installment loan like a credit builder account from a credit union. Monitor progress. Use free tools like Credit Karma, Vantage Score, or My FICO for real FICO tracking. Aim for 20 to 50 point gains in 3 to 6 months with consistency. A 700 credit score won't ruin your life, but it can quietly shape it. It can mean higher monthly payments, slower wealth building, more money lost to interest, less flexibility during emergencies. Over time, those small disadvantages compound. And compounding doesn't just work for investments, it works for costs too. That's the part no one advertises. If you want clear, honest explanations of how the US financial system actually works, without hype or sales tactics, subscribe for more videos like this.